Welcome back, everyone. And today we're going to have a very nice episode, as always. And it's a great topic. The title will be Buy, Borrow, and Die.
Oh, wow. Interesting.
Hey,
That
sir.
sounds interesting.
Once again, my co-host is Julie. How are you?
Good morning, Seewing. How are you?
Thank you. Welcome back, Julie. Julie is one of our network top real estate investor, and she has done a lot. And we have documented her journey at various videos. We have so much to cover, so much opportunity, so much information. Thank you for attending. Let's go ahead and share my screen. Here we go. Buy, borrow, die. Good thing is a very positive spin, multi-generation real estate wealth transfer down the road. All right. Let's go through it. It's all about generational wealth, right?
Yes.
Whether you invest in real estate or invest in whatever strategies out there, we all love to achieve financial freedom and enjoy our lifespan. Hopefully we can do a multi-generational legacy transfer, not only transfer our real estate tax-free into our children, then our children into multi-generational can use the same real estate income property, continue with this legacy of financial well-being. So don't you want that? Don't we all?
That's even spoken to in the Bible where it talks about leaving your children's children an inheritance. So yeah, that was done long before we got here. It's definitely something that everybody should strive for.
Absolutely, Julie. We can share some great information, a great blueprint, and you'll be shocked as to how lucrative real estate is. If you do it right, if you follow the plan, have your goals and objectives set in place, it's a long-term journey, but very worth it, right?
Absolutely. 100%. Yes.
Yeah, that's right. Create a legacy for multi-generational. And how we do that is we can use the absolute power of owning rental property. Imagine we can create wealth through real estate, through income property, and pay little or no taxes for years to come and enjoy the passive income, enjoy the equity, right?
That's awesome. Who wouldn't want to do that? And tax-free.
That's right. It has been done over time, and you guys can do it moving forward. We have so many slides to share, but very little time to go over it. Each I can only spend 30 seconds per slide. Julie and I discussed this a number of times. Rental property is the most attractive, multi-dimensional real estate investment asset class because you get paid 4 different ways: cash flow, tax benefit, appreciation, and using the power of a 30-year fixed rate debt to leverage your investment. And as we all know, most of us can only see the cash flow and appreciation, but below the surface, below the iceberg, where a lot of the wealth is being built, is the tax benefit, leverage, principal pay down by the tenant, and inflation-induced destruction. So most real estate gurus out there and YouTube content creators promote these types of houses and hype their paper gains, do fix and flip, burst strategy, buy, renovate, refinance, and repeat.
Right.
What kind of sexy, easy to do, get rich quick scheme using rental properties. And it's just so many people are being brainwashed by this investment strategy. Julie, you saw these over the years, and you have your friends also, unfortunately, enter into this type of overhyped investment strategies, and they got burned. What are your thoughts about this?
It's so interesting. A lot of the gurus will preach all these different creative strategies, the fix and flips and the burn. Not to say that those are not viable strategies, but I think they pitch them to people that have never been in the business, don't really have an understanding of investing in real estate, and they charge a lot of money. Based on what we have done through your network, the money that they are paying just to pay for the guru's services, they get about 1 or 2 houses based on the way you have taught us how to do the strategies. So they're not bad strategies. They're just not for everybody. I think the average person will get burned trying to do those types of strategies.
Agreed. You're absolutely right. And Julie, so we have some of their strategies: find the most dilapidated property somewhere in a country, mostly in a Midwest area. In your situation, it has worked very well when you bought your portfolio of rental properties in upstate New York. You're doing very well because we have a great team, great concept and all that. Most of these overhyped strategies promote cheap properties like $69,000 somewhere in the Midwest, 50 to 100-year-old. Look at this, $34,000. All fixer upper. You offer to buy this property 50% discount, and then fix it, renovate it. It's just a step of the way is so risky, especially out of state investors. Oh, look at this. It's just not that simple to buy older homes, 50 to 100 years old, requires so much effort just to buy the right kind of property. If you can find the right guru, right content creators, and you have to spend money to fix the property. How much is the rehab cost? You have to trust the team on the ground, the contractors. When you buy these much older properties, whether 1 or 4 units, a lot of these fix and flip and burst strategies, they're located in a C-class neighborhood. And whether it's a 1 to 4 unit, whether it's a commercial or buy and hold, you look at the maintenance factor. Lower the quality of the house, of the neighborhood. You got the low tenants, low class tenants, the transients. If it is a C-class neighborhood, look at the potential maintenance on an annual basis, like 13% of your rent goes into maintenance. A low-class tenant, vacancy factors. Each time you have a vacancy, you can spend thousands of dollars to clean out the property and try to rent it out to another low-class tenant. It's a cycle. And the same thing with on a commercial unit, 5+ more unit, the maintenance factors and the vacancy factors are even higher, 12, 15, 13%. Then yet the boiler breaks down, the electrical system breaks down, the roof crash. So at some point in the next few years, you could spend additional $5,000 or $10,000 replace the roof, and that will eat up into cash flow. What's your thoughts on this?
Absolutely. The maintenance, and that's just one of the costs that will offset any profits or cash flow you might achieve from the property. And like you said, the neighborhood is a big factor. If you're looking at a place where you've never lived before, you just saw something online that looked good, there's a very high risk that it will not be profitable at all or for a very long time.
Yeah, well, this kind of Midwest markets, not only Midwest, it could be anywhere in the U.S. The projections, low cost, very high cash flow.
I love that. It's not sustainable.
This type of rental houses is not sustainable. Today's topic, we can buy and hold forever, really. Buy older homes that require a lot of maintenance. It's very difficult to keep this house for a lifetime. So this type of portfolio, as you can see by this plan, is not sustainable. Legacy transfer is not multi-generational transfer. I'm not saying all of the houses will not work. It have a lot of risk in buying older homes in a market where your team are not the best team on the ground to help all that. Just be careful out there. It's a lot of risk. So here's our methodology, Julie. Instead of doing that, use this very high benefit, low risk methodology that we've been preaching within our investment model, a business model, which is real estate's absolute gold mine. Is you need to focus on small town USA. Small boomtown. You buy in the emerging boomtown markets. Passive growth. First come, first serve. Get in before anyone else. You buy into commuter towns, rural towns. This information I'm sharing, Julie, is so new to a lot of people, especially newbies, but a lot of experienced investors have not heard about this investment methodology. I tell everyone, Julie, wake up a bit and smell the real estate roses.
Absolutely.
Wake up and smell the real estate roses by using this type of strategy. Okay, let's continue. So you build in underserved America, the rural communities, the commuter towns within 1 hour away from the major metros. The population typically around as low as 10,000 people to 50 or 100,000 people in those rural commuter towns, those emerging markets, mostly in the South and Southeast, some in the Midwest region. And get this, in the home prices are 50% below the national medium price, which is national medium price of a home is right now is around 400,000. So therefore, these are the type of homes, the entry-level homes that investors that we help investors buy 150K to 200K
Right.
family home. And look at it. And here's some additional metrics you need to look into it when we enter this type of emerging market. Of course, you need job and population growth. That's most important.
Right.
Belt, yeah, Sunbelt, really nice. Warm weather all year round. Wow, how cool is that?
Absolutely.
Surrounding, expanding colleges and universities, healthcare industry, new infrastructures, close to major military installations. Several major employers are moving into town, such as, but not limited to, major manufacturing plants, high-tech hub, data centers, bringing potentially thousands of jobs in the next few years. We focus on new construction, single-family home, duplex and fourplex, and of course, the rental market will be very strong in this emerging market. So, Julie, what are your thoughts on this past?
I think that the thing that all of those have in common is bringing more people to the community. If you're expanding your colleges and universities, you've got an endless flow of students coming in, teachers coming in, being transferred from other parts of the country or other parts of the state. Military, very high quality tenant, if you think about it from that respect. I would imagine the military would subsidize housing for their military, for their vets. So so it's a constant supply. And if these industry are being built, high-tech hub, things like that, it's going to bring more people because businesses go where they expect people to buy or to be able to serve the communities. All of those are very outstanding factors to look at when you are looking to buy investment property.
Exactly. And Julie, my network has been up to. And the blueprint to implement this type of strategies in these types of markets moving forward in 2025 and beyond, you buy new construction. New builds typically have better locations. You get higher quality tenants. Tenants typically stay for 2 to 3 years at a time. And as I alluded to earlier, very low maintenance costs because a lot of these new construction have a 1-year warranty, a 10-year warranty, and they're brand new. They're not in a flood zone, away from the hurricane, no HOA, low insurance costs. Some markets have no state income tax, which is great. Landlord-friendly stakes, we all want that. Emerging markets, path of growth, low affordability for investors, entry-level homes. We have many other markets in the South and Southeast. For example, in Lawton, Oklahoma, new construction, 150K. You will not see any new construction for 150K anywhere else in the country. You get some nice cash flow, right? $1,250 rent, monthly net cash flow $317. The cash on cash returns is 8.6%. Most national builders, when they build new homes in certain markets in the US, homes starts at 400K all the way up to 600K. That is a traditional definition of an entry-level new construction homes was built by national builders. The national builders do not build entry-level new construction homes for 150, 200K. There's no profit margin for them.
Sure, that makes sense.
We have relationships and connections with local, regional builders in various markets. They're building new construction homes built to rent for investors. So investors, we can buy them and we place the tenant into these homes. So that's very rare. Regional builders are willing to build low-cost, entry-level new construction homes in emerging markets for our investment group.
I'm just thinking, for a new investor, something like this is going to be ideal. Is it going to cost you a little more than finding that one property in the middle of nowhere? It's for $20,000, and you got to put another $50,000 worth of work. Really, to do it this way, it's already built, ready to move in, already under management. Everything is set to go. In the long run, this may look on paper like it's going to cost you more, but doing that other strategy, you don't know the neighborhood, you don't have any contact. It will cost you way more in the long run. And I didn't understand about turnkey. That was something new to me until I met you. As a new investor, that's the best and safest way to go.
And over the 5 or 10 year period, you buy new construction, even at retail cost. Over time, the vacancies and maintenance and upkeep are so low compared to a regular rehab property. We can do the comparison. Buying a new build over time will be more profitable than buying a traditional renovated house. And look at this duplex, new construction duplex. Where else in the country? You can buy a new construction duplex, such place in fast-growing Oklahoma for $320K, both door rent for $2,500, 2 units, monthly net cash flow The first year, $607.
Nice.
Look at the cash on cash return, 8.3%. This is off the chart. We're not going to go over long-term profit. You can do the calculation. We can talk about it some other time. You get a builder's rate, buy down your interest rate. They pay your property management fee for the first 2 years.
Nice.
All the incentives
Nice.
on top of everything else. And of course, we have other markets. I'm not going to go over specific market. We have so many markets. This other construction that we have in other part of the country, similar emerging market, low cost, good cash flow. This is in Florida. It could be, there's another new fourplex in South Texas, really emerging market, very low cost, high asset class, plex for $545K, or Bodo rent for $5,400. You pay 5% down payment. Don't even worry about the mortgage rate. If the mortgage rate is 7%, it may make a small dent in the cash flow because you can always refinance in the future to improve your cash flow with a lower mortgage rate. The rent to price ratio is 1%. When we hear about the 1% rule, mostly high cash flow areas such as in the Midwest, you buy old dilapidated house, very low cost, very old, then you rehab it, fix it up, rent it out, and refinance. You can buy a 1% rule in a high growth market for 1% rule, rent to price ratio, and cap rate 7.5%, cash and cash return 6%, total return on at the end of the first year, 28 to 30%. Total return means annual net cash flow plus projected first year annual depreciation and loan pay down. All these are profit opportunities that equate to total ROI, as you can see right here. So we have other video talk about profit calculation, this and that, numerical form, but we don't have enough time. So anyway, the other properties, other fourplex, brand new, similar situation in other part of the country. You just fast forward. And in some point in time, you buy in different markets for long-term rent. That's your first goal. In some markets, in the next few years, you may be able to convert some of this long-term buy and hold strategy into a mid-term rental or short-term rental Airbnb. And we are testing out some of these markets in Oklahoma. We are testing the short-term market, and it appears to be working. It's a small sample size so far, but Richard Ibani, our turnkey provider, he's testing on his own property in Lawton, Oklahoma, 150K construction single-family home. He's converting into Airbnb, and he's working.
Well, that's a great strategy. It leaves you a lot of options. The first thing is get the property, and then you can have a lot of different options that you can explore. But if you never get in, then you never have the opportunity to try anything.
Exactly. A lot of real estate gurus promote short-term rental, mid-term rental, very deceptive the way they market their services. The way I look at it, when you buy a rental property, you buy for long-term rental. That's the blueprint. And down the road, if the market makes sense for mid-term rental or short-term rental, you have the option to do mid-term rental or short-term rental. We're not going to go over details, but suffice to say, typically a successful mid-term rental, you normally get 50% higher rent than a rental. A successful short-term rental Airbnb, potentially you get 100% higher rent than a long-term rental. To mitigate any kind of risk, when you buy turnkey properties, new build, you buy for annual rental, long-term rental first and foremost.
Absolutely. Makes 100% sense.
And down the road, you and I are not tax advisors. Imagine. The purpose of this topic is you buy, you borrow, and you die. Over time, when you slowly buy properties in various markets, little at a time, 1 or 2 per year, depending on your capital availability, down payment ability, everybody's situation is different. But you can hire a licensed CPA. They could help you to look into depreciation, cost segregation, short-term tax loophole, real estate professional tax status, and 1031 tax-deferred exchange. Hire a team of financial professionals. You can incorporate these tax saving strategies. It could save you tens of thousands of dollars over time on all of your rental properties. Any quick comment on this amazing tax benefit when you own a rental property?
I think that looking at these are all those below the surface advantages you can take advantage of, especially as a newbie. The only two things you're really looking at is cash flow and how much it costs basically to get into the property. But these are all things that are really going to make that short-term mindset a long-term mindset, because you're going to benefit over time. People have to understand. It's not a fly-by-night. It's not, oh, I'm going to get rich in a year and a half. It's over time.
Yep. You're absolutely right. At the beginning of the presentation, we discussed cash flow and depreciation. The surface is tax benefit, as you can see right here, and the tenant paying down your loan.
Right.
And using the power of 30-year fixed rate debt to leverage your investments to give you a higher return. A multi-dimensional asset class, and tax benefit is one of the major components of how you make money and how you save tax. The second portion, as we said, buy, borrow, and die, and reaching the borrow component. So people think borrow is bad debt. No. But when you borrow through real estate, it's a different concept. It's a different mind game, right? So it's a game changer. So when you own rental property the next 5 to 7 years in a high growth market, some of those markets will appreciate more, and have enough loan to value, like around 50%. You have the ability to catch a refinance, tap into the equity of your rental properties, and buy leverage into more property. And the beauty of it, if you need the equity, you use good debt refinance. When you refinance, you tap equity via the debt cash out refinance. There's no taxable event. Borrow against the equity of your rental portfolio. You don't pay taxes. It's amazing.
That is amazing.
As long as you use the cash out refinance to buy income producing assets, right? Okay. You don't want to cash out refinance to buy a Lamborghini or something.
Right. Which a lot of people will do.
That's not the right thing to buy. You buy appreciating asset that grow over time, big wealth for your family, not appreciable assets such as
exactly like a car. The minute you roll it off the lot, you've lost money.
Once you buy 2, 3, or 4 properties, your equity will grow appreciation 3 to 5%, maybe more, depends on what market. The next 5 years, you own 3, 4, 5 properties. Your loan balance is being paid out by your tenant.
I love that.
Yeah. The two words you need to learn: outsource and leverage.
Yes.
Leverage, when you borrow against the bank on a 20 to 25% down payment, and your bank will lend you the remaining 75 to 80% of the value of your property. Then when you place a good tenant on your property, they will systematically pay down your 30-year debt. So in the 5th year, your loan balance will be lower. The market value of your real estate portfolio will grow larger. When you reach the equity position of we call it LTV. I don't know. I don't have to explain loan to value. You have the ability to refinance. Some of these rental properties, I know some of you thinking, you refinance, you have more debt, you have more payment. It's a payment absorbed by the rental income. Your rental property is a wash. You're not putting yourself in a negative cash flow scenario when you catch a refinance and make the house mortgage payment higher. You have to work with a loan advisor.
Absolutely. Yes.
Crunch the numbers, right? If you're not a numbers person, hire an investment loan advisor that will go over the pros and cons and the numbers about cash out refinance. So you're not going to put yourself in a negative cash flow situation when you take out additional equity debt. Does that make sense?
That makes 100% sense. It is a very good strategy, but you have to make sure that it's right for you. Get some professionals that can run the numbers for you and make sure it's going to work out for your specific goal.
Yeah, if your so-called retirement 20 or 30 years away, you could continue to, I call it rinse and repeat. When you hear the word rinse and repeat, what does it mean to you?
Oh, just do it again. Once you figured out the strategy, you just do it again. So yeah, that's the same thing we did when we bought our properties. That's why we were able to buy them so quickly back to back. Because once you figure out how to do the first one, it's like, okay, I can do this again up to the 6 properties that we were able to purchase.
Yeah, the power of leverage, the power of outsource. This is the first 5 years, for example. Then 3 to 5 years, you can rinse and repeat. You can catch up, refinance some more of your rental properties. Not all, based on your goals. If your goals are 20 to 30 years away, you will it behooves you to continue to scale your real estate portfolio, right?
Absolutely.
If you are 3 to 5 years away from retirement, then you may want to catch a refinance too often, right? You
Right.
want to live off the passive income so you can,
Absolutely. 100%.
everybody goes through situations different. We just go over a lot of different strategies. The ability to catch a refinance a number of times based on your long-term goals and strategies, and everybody else is different. A lot of the homes today all over the country, including in California where you and I live, are 50 to 100 years old.
That's true.
Yeah, similar in Southern California.
Right. Right.
Homes in Southern California and Northern California, as expensive as it is, very old homes. Like at the city of San Francisco, the homes are more than 100 years old. At some point in time, the next 30 to 50 years, a lot of these older homes, they're not going to last long. So when we buy new construction, we can have this new construction 50 years from now.
That's right.
It's only 50 years old a home. So
That's a very good point.
years from now, on your third, fourth generation within your family, they could inherit those property tax free. It'll be
Right.
100 years old, 100 years later. Today's older homes, especially in California and the Western region, the Northeast and the Midwest, are 50 to 100 years old. Whereas the homes in South and Southeast, a lot of those homes are new.
Right. That's right.
Escape.
That's a really good point. You buy something new and you can pass it down 3 or 4 generations. That's a great concept for buying the new property.
Julian, what I just said are not being discussed enough by those so-called real estate gurus out there. They just want to entice you to buy those older homes, high cash flow, rehab, refinance, burst strategies. Fix it. It's not sustainable. It's not a legacy factor. It is because of the stress of maintenance and upkeep. Older homes will quit before they could ever reach the level where they could transfer their estate to the loved ones upon death.
Very good. You were talking about rinse and repeat. You can do that for generations. Your kids can do that. Your kids' kids can do that. But it's still the same property. Everything that great-grandfather worked for is still being benefited by the great-grandkids. So I think that's a great strategy.
Now people see the value of buying new construction today.
Absolutely. Makes sense.
You can hold a hold forever model. Once your property increase value over time, I know there's certain years where you may lose value. You buy for the long term. When you risk a portfolio, a gain from year over year appreciation, 3 to 5% or more, the gain is only taxable when you sell the property. But don't sell for the most part, right? If I never sell, I'll never have a taxable gain.
That's true. That's a good point.
For example, today, 2020, in some markets, you might have a slight correction, 5 to 10% decrease in value, but you're not losing money as long as you don't sell. Paper transaction.
Exactly.
You keep the property even during a slight downturn because over time, real estate always appreciate.
That's right.
On a downturn,
Never sell.
Continue to collect rent, continue to collect tax benefit. Even if your property, one short time frame, has gone down in value for a few percentage points. Who cares? You buy for the long term.
Exactly. That's a very good point. Because if you're talking about passing it down 2, 3 generations, that's a long-term mindset. And I think people really need to look at that, especially if you have children or grandchildren. This is a very viable strategy so that your children and your children's children can have a solid foundation of generational wealth.
Yeah, we don't want to see people go through poverty, struggle around finances. It affects all aspects of the quality of life. If you pass on the money principle that are being used, and you're a Christian, you go to church, and you talk about the money principle.
Absolutely.
Be a steward to your money. It impacts positively not only your family, but your community as well. People can focus and live a quality life. If my heirs inherit all the property, you achieve financial freedom, you use the equity to enjoy life, to go on vacations, to spend time with your grandchildren. When you pass at age 90, or when your loved ones, your estate, your beneficiaries, your children or grandchildren inherit your property at the date of death, they will get a step up in basis. So they will inherit the money tax free.
I love that. That's really amazing.
Amen. So in
Yeah.
this concept, buy and borrow and die, this concept been around for a long time.
Yes.
But most people think only the rich use this strategy. No, you could be low class, middle class, whatever
Doesn't
class.
matter. Mhm.
You can do this. America is a land of opportunity. It doesn't matter how smart you are, how poor you are. If you have the motivation, commitment to do this kind of things, you can do it. The American dream is alive and well, regardless whether you were born in the U.S., regardless you're an immigrant. If you have the motivation, the commitment to achieve financial freedom, you can achieve this kind of strategies.
Absolutely. Yeah, 100%. It doesn't matter where you are. Because as you've shown on previous videos, it for some properties around the country, it doesn't take that much to get in. Some people will spend more on their Starbucks each year than it costs to put a down payment in a house. So it's just readjusting how you manage what you have and using that for an asset that's going to last you a lifetime, or like you said, multi-generational.
Yep, exactly. That's correctly. So our strategy, as we are concluding this presentation, buy new constructions in the high growth market, buy for cash flow, 20 to 25% down payment, and surround yourself with a great property manager on the ground so that you can do it remotely, long distance. It does not matter whether you own 5 rentals or 10 rentals, 50 rentals. The most amount of time you spend on a monthly basis to manage your real estate portfolio is how many hours per month? Judy, answer that question.
Less than 1 hour per month. Yes, that's about what I spend managing my property. All the hard work, all the heavy lifting is done by my management team. And all I do is just reap in the receipts, write in the receipts, and keep it moving till the next month.
That 1 hour of your time per month is counting the number of rental checks you get.
Exactly. That's pretty much it. Logging them in takes me less than an hour now.
You buy a new build, it lasts you multi-generations. As we discussed, is a multi-generational legacy transfer.
Right.
And finally, many of you need coaching and mentoring. I'm available. Contact me at your leisure. Then we work together one-on-one. If you receive any value from this presentation, please like and subscribe to my YouTube channel. Put your email into our newsletter database, bottom of the description, so you can receive this type of real estate investing information into your email inbox on a weekly basis, daily basis, so you can take action to achieve your own definition of financial dream. So any last remark before we
No, it's just been a great meeting and learning about how to pass that on so that the legacy doesn't have to stop with you. I think most people, when they're buying an investment, they want to pass it on to their children. So understanding that can have potential benefits of being passed along tax-free, why not? Who would not want to do that?
amazing strategy. The money you can make over time, very little tax. You can enjoy the return to achieve the quality of lifestyle. If we live a healthy lifestyle with a long span, joy while you're here on earth, and then
Absolutely.
pass it on and make the world a better place for everyone. Don't you agree?
I agree 100%.
All right. Thank you. Thank you so much for attending. Thank you for your Julie for your.
I always learn so much when I come on these calls.
Good to hear. All right. That's all I have to say. See you guys next time. Have a nice day.